Hello and welcome to this episode of Mic'd Up. I'm Pete Seyler, part of our business development team here at iCM. And today I'm joined by a returning guest, Catherine Legraw from GMO. Catherine, thanks for joining us again.
Oh, thank you so much for inviting me.
So we're going to jump right in. And one of our largest concerns here at iCM and ultimately based on what we've read and heard out of GMO, it appears to be one of yours as well, are sky-high valuations in the U.S., particularly large cap and large cap growth being the greatest offender. We've always had, been proponents of the benefits of diversification, in particular avoiding the most overvalued assets of the market. And one thing, GMO has written recently that there's a near historic opportunity for diversification. Can you talk about that a little bit and give us some insight into what you really mean by that?
Yeah, well, we certainly share your concern about the US equity market. First and foremost, you're right, it's all about valuation. So when we're analyzing the US stock market today, on pretty much any valuation metric we look at, it is expensive in relative terms. It's expensive compared to other markets, but it's also expensive compared to even its own history. And this is on more conservative metrics like a CAPE, a cyclically adjusted PE ratio, and also more aggressive metrics, even price to forward earnings, where you give credit for forward growth. So that's concerning. But then you also mentioned, and it's in particular this large cap growth segment. So when we look at growth valuations within the US, so growth compared to the US market, they're at historic highs too. So you've got expensive on top of expensive. And then I'd add one more problem to this mix, which is an index like the S&P 500 is at peak concentration relative to history. So there are a handful of these mega cap growth names. You know them, NVIDIA, Microsoft, Apple, Amazon. They make up an enormous proportion of this index. So usually I think investors love indexes because they give them diversified exposure to the entire market. And in this circumstance, you're getting a lot of specific risk, a lot of idiosyncratic risk when you buy the S&P 500. So for this reason, we think anyone who's willing to move away from mega cap growth stocks in the US stands to benefit enormously. It's an extraordinary opportunity for diversification today. And we've done a little analysis around this that I'll share with you.
Oh, great.
We've taken a look at what's the potential reward to doing something different? What's the potential additional return you can get if you're willing to allocate away from a traditional passive portfolio, away from the S&P 500? And we chart this through time using our long-term asset class forecasts. And what we find today, this line, which represents potential active return compared to a passive balanced portfolio, this is the highest it has been in the 35 years we've been tracking it.
Wow.
And that is because you can perform so much better if you're willing to do something different. You can really reap reward from diversification today.
So that's really great information, but let's take kind of another step forward. Where do you see the greatest opportunity for investors who are required to own at least a portion of their portfolios in U.S. stocks? How would you recommend they position those portfolios?
I actually say there's a lot to do in the US as long as you're willing to move away from mega cap growth. My first suggestion to you would be consider active management. The past decade of rising concentration has been a really tough environment for active managers. When the biggest stocks in the index keep getting bigger and bigger and bigger, the active managers who bet against them, it's tough to win. But
Sure.
we think that's at a peak. It's likely to reverse, and the next period is going to be much more conducive to active management. My personal opinion is when you've got so much expensiveness, so much concentration, you want someone actually taking a disciplined approach, looking at fundamentals and looking at valuation. So that's my first suggestion, just to consider something active in the US. My second suggestion is consider a quality bias. When I say quality, I mean stocks with high profitability, stable profitability, low debt profiles. This is a wonderful factor. It consistently protects you in the case of a downturn. In the case of a reversal, these stocks draw down by less because they're so strong, and you don't have to pay up for this portfolio. It is no more expensive today. So consider that quality tilt in your portfolio. Now, if you want to get a little bit more exciting in an idea, small cap is pretty well priced in the U.S. This is kind of moving away from those mega cap stocks. And interestingly, the quality factor within small cap works astoundingly well. We've done a little bit of analysis on this that I show you on this page. This is looking at the performance of small quality relative to small or relative to the market through time. And you can earn an additional 2.5% annualized from a quality tilt in your small cap portfolio. That's an amazing number. And the intuition behind it is you've got a very varied universe in small cap. You've got a lot of companies that maybe aren't the highest quality. Some of them are companies who are in a downward spiral. They've fallen into the small cap universe. Some people might call them falling knives. You sweep those away. You've got other companies that have a lot of promise and a lot of potential, but not a lot of profits. Your negative income earners. You kind of sweep those away. And what you're left with is a core portfolio of very good, very stable companies that just happen to be small caps. So if you want to move completely away from mega cap, you might consider small caps. And I think that a small quality portfolio is the way to go there. And I have one more idea in the US for you. And this is for really people who are willing to be adventurous, people who are willing to take a bet. And that is deep value. So I think of deep value stocks in the US, the very cheapest stocks in the US market. These are the stocks that have gotten left behind in the mega cap growth kind of fervor and rally. And they are outright cheap today. This chart is a valuation analysis we've done for the US equity market. But instead of just splitting the US equity market into growth and value, we've split out the very most expensive growth stocks and the very cheapest value stocks, so those top and bottom lines, and filled in the growth and value universes with mid-growth and shallow value. Here we look at historic relative valuations for the cohort, and then off to the side, we note a percentile. So how cheap or expensive is this cohort compared to its own history? If everything were 50th percentile, everything would be trading exactly in line with their own history. But in the US today, we see this extreme growth, mid-growth, shallow value categories. They're all trading expensive compared to this own history. And then you've got these deep value stocks trading bottom decile compared to history, really a wonderful valuation opportunity. So if you really wanted to try something interesting in the US, there are a ton of cheap stocks in the US today that are just being overlooked by many investors.
Awesome. Again, great info. And as we move on here, one of the factors that we found that investors sometimes overlook is the direct impact that the dollar has on non-U.S. asset returns. So with the dollar near multi-decade highs, what does this mean for both international stocks and bonds, in your opinion?
Yeah, so something we often don't think of from a US perspective is what's
Absolutely.
the impact of currency here? And normally I think it's not a big deal to forget about it. Currencies are volatile. They tend to trade in a decent range around fair value. You don't have to worry too much. Today's an exception. So in addition to that US market expensiveness, that growth expensiveness, the US dollar is also at peak expensiveness, which is kind of great for us who have portfolios in US. Your dollar is very strong. If you want to go outside the US today, you can get a nice cheap vacation in Japan or Europe. It's a good time to be a US dollar holder. But when you think about investing, you've got a risk of the dollar depreciating and other currencies there therefore appreciating. So when you invest outside the US, you've got the potential of an additional benefit. The benefit of an additional tailwind from cheap currencies. And I have an exhibit that would help with this. We've actually tried to quantify how much of a potential benefit is that in forward-looking returns for non-US assets. And it's pretty substantial today because not only are non-US currencies cheap, some of them are historically cheap. The yen, for example, is the cheapest we've ever seen in history. So this chart shows our forward-looking expected returns for various equity groups. And these capital market assumptions might look different from other capital market assumptions you see. First, these are forecasted returns in real terms. So we're projecting return above and beyond inflation. You could add an inflation expectation to these. And second, in addition to long-term growth and yield, we're also adding an expected return from valuation. So if an asset is expensive, we add a negative return from expected negative repricing. And if an asset's cheap, there's an additional positive return from expected positive repricing. So here you've got an asset like US large cap stocks all the way over to the left, that's S&P 500. Negative probably looks pretty shocking because we do have good positive growth in the US and we're getting nice yield from our assets. But the trick here is we're expecting the US market to reprice back in line with historic valuations. However, when you look away from that, many groups of stocks outside the US are very attractively priced. You get good valuations. You also have the potential to go into interesting segments that are misvalued or even extremely dislocated versus history. Deep value, small cap value, wonderful additional returns. These are all of the solid bars. And then to look at how much additional potential return you could get from currency, we've added an additional currency tailwind return, this kind of outline in addition to the solid bars to show, hey, you could get benefits from the fact that you're investing in cheap currencies as well. And there's two ways you can win as a US dollar investor. One, the currencies could appreciate and your US dollar return will be higher. And two, even if the currency doesn't appreciate, even if the US dollar remains expensive and the euro remains cheap, you still get a benefit from investing in companies in cheap currencies because they tend to have higher earnings growth. They tend to exploit their low cost advantage. So we think it's enormous, maybe even 2 to 4% additional return today from currency.
That's pretty significant. Catherine, I want to thank you again for joining us for a second time. It's always great to have frequent flyers come back and join us. I hope there'll be a third time in the future.
I do too. Thank you so much.
Thanks. If you'd like to discuss today's topic in more detail or have a suggestion for a future episode, please reach out to us at 888-426-4689 or via email at info@icm-invest.com. Thanks for watching.